Mark, on the session looking at what's going to happen in the future with regards to M&A activity, we spoke a little bit about where we're going to see an increase in M&A activity. And one thing that came away quite clearly was this issue that M&A activity, yes, is on the uptick, but it's possibly more at the large end of the spectrum rather than the smaller end of the spectrum. Is that something that you're seeing from your client perspective as well?
Yeah, I think M&A volumes are up this year, and I think that's a result of having an increasing number of years accumulated of stable markets and people getting comfortable with valuation levels and predictability of earnings, as well as the availability of capital. And I think companies have emerged from a period post the financial crisis, if you like, where if they had balance sheet restructuring to do, disposals to make, they've now had a window where valuations and multiples were satisfying enough they could make those disposals. And I think that leaves companies coming back to some of the deals they've not felt confident doing in the last 5 years, the bigger deals. And therefore, I think you're seeing a greater proportion of whole company trades, whether it's mergers or takeovers, rather than divisional disposals.
You mentioned valuations just now, and that we've seen a period of stable valuations. One of the possible risks to the sustained M&A activity could be a valuation bubble. Is that a concern that you share, or are you a bit more optimistic that valuations are actually developing at a reasonable rate?
Certainly, I think we are seeing valuations and multiples which, by standards of a few years ago, have run ahead a bit. Markets are high. I think a lot of that rise in markets has been driven not yet by earnings growth, but by multiple expansion. And we've certainly seen some situations where we've been in dialogue with companies who weren't in a position to buy something a year ago, but now wish they could have done because valuations have now got to a point where the deals are less satisfying. So I think people are working hard to stretch to see if they can justify these prices, and on occasions they can't. I think the key question is whether earnings growth continues effectively to catch up with those multiples. I think quite a lot of earnings growth is now beginning to be built into the prices at which companies are trading, and we'll see. I think if we go through a results season at the half year which suggests that earnings growth is petering out, then we might have a valuation dislocation. I think it's just another factor people are factoring into their analysis at the moment.
Okay, let's wrap up by speaking a little bit about Dualtrack processes. That was something that was mentioned on the panel as well, that we're seeing more and more of those, and that they are actually true dual-track processes where an IPO is considered as a serious option rather than just something that's thrown in to flush out any other buyers that might be a little reticent at the moment. Is that something that you share?
Yeah, look, I think there's no doubt a lot of flotations are getting done, and getting done at decent valuations. There's been a huge level of support and demand for the books that have been building, and I think that does give people the confidence to launch with an IPO as a base case. And if that happens, that's fine. They're getting a decent price for the equity they're selling. If something better comes up in the process, they might take that. But I think there is increasing confidence that if the IPO happens, that's a pretty good base case result.
Okay, thank you very much for that, Mark.
That's all. Thank you.